Hey, what's up, everyone? Welcome back to Finance Unlocked, the channel where we unlock the secrets of the financial world. In today's video, we're going to talk about the difference between public and private companies. You may have heard these terms before, but do you know what they mean and how they affect the way businesses operate? Well, don't worry, because we're going to explain everything in a fun and easy way. But before we start, make sure you hit that like button, subscribe to our channel, and turn on the notification bell so you don't miss any of our awesome videos. And if you want to support us even more, you can comment "I subscribed" below and we'll give you a shout out in our next video. Alright, let's get started. First of all, what is a company? A company is a legal entity that is created to conduct business activities. A company can have one or more owners, who are called shareholders or stockholders. A company can also have employees, managers, directors, and other stakeholders who are involved in its operations. Now, there are two main types of companies: private companies and public companies. The key difference between them is how they raise money and who can invest in them. A private company is a company that is owned by a limited number of shareholders, usually the founders, management, or a group of private investors. A private company does not trade its shares on the public stock market, which means it cannot raise money from the general public by issuing shares. Instead, a private company relies on private funding sources, such as bank loans, venture capital, or personal savings. A public company is a company that has sold some or all of its shares to the public through an initial public offering. An IPO is a process where a company offers its shares for sale to investors on a stock exchange, such as the New York Stock Exchange or the Nasdaq. A public company can raise money from anyone who is willing to buy its shares. A public company must also follow strict rules and regulations set by the government and the stock exchange, such as disclosing its financial statements and performance to the public. So, what are the advantages and disadvantages of being a private or a public company? Let's take a look at some of them. One advantage of being a private company is that it has more control over its business decisions and strategies. A private company does not have to answer to shareholders or regulators who may have different interests or opinions. A private company can also keep its information confidential and protect its trade secrets from competitors. One disadvantage of being a private company is that it has limited access to capital and resources. A private company may find it harder to raise money or expand its business without going public. A private company may also face higher interest rates or stricter terms when borrowing money from banks or other lenders. One advantage of being a public company is that it has more access to capital and resources. A public company can raise money from a large pool of investors who can provide funds for growth and innovation. A public company can also use its shares as currency to acquire other companies or assets. One disadvantage of being a public company is that it has less control over its business decisions and strategies. A public company has to answer to shareholders and regulators who may have different interests or opinions. A public company also has to disclose its information and performance to the public, which may expose it to scrutiny or criticism. So, which type of company is better? Well, there is no definitive answer to that question. It depends on the goals and preferences of each company and its owners. Some companies may prefer to stay private and enjoy more freedom and flexibility. Some companies may choose to go public and benefit from more exposure and opportunities. Some companies may even switch from one type to another depending on their circumstances and needs. For example, some famous companies that started as private companies and later went public are Facebook, Google, and Amazon. Some famous companies that started as public companies and later went private are Dell, Hilton, and Heinz. So, there you have it. The difference between public and private companies explained in 10 minutes. We hope you learned something new today and enjoyed this video. If you did, please give it a thumbs up and share it with your friends. Subscribe to our channel for more videos like this one. For watching Finance Unlocked, and we'll see you next time.